This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Robert Carver. This is his second appearance on the show. He came on the first time to support his first book, Systematic Trading. Imagine that. Imagine that I would want to have somebody on this show who writes about systematic trading. His newest book, Smart Portfolios, a practical guide to building and maintaining intelligent investment portfolios. This is one of those reference books, like my own newest edition of Trend Following. Yes, quick plug. This is one of those reference books that you put on the shelf. One of those great, just the facts, very practical reference guides that you can't go wrong with. Hey, Robert didn't give me a penny to say that. I got the book here in front of me. It's a solid piece of work. Check it out. Before you check it out, and before you listen to Robert on this show, oh yes, I do have a request. Go to your friendly neighborhood Amazon, and if you have not already grabbed a copy of my newest edition of Trend Following, please do. And if you have already grabbed a copy because you know it's kind of cool, whether you went with the hardcover or whether you went with the 34-hour audiobook, since you know it's kind of cool, and if you already have it, a family member, a friend, a business associate, buy it for somebody. Support the podcast. Also, one other thing which I've not really asked for a long time, I mean, recently I've asked for it, but not for, frankly, over a year, podcast reviews. Please go to iTunes, offer a review of this podcast. I want to see your feedback. Why do you listen? I know you listen. I can see the hundreds of thousands of listens every month. I'm well over 6 million in total listens. So there's a reason everyone is tuning in. I'm not trying to be cocky. I'm just trying to get some reviews for the show. So please support your favorite podcast host. That would be me. And go grab a new copy of the Trend Following Manifesto that I have put out this year. Or please think about writing a review. Now for my guest, Robert Carver, in support of his newest work, Smart Portfolios. I hope you enjoy this conversation. I have your newest work in front of me, and I must say, this is a great reference. It's not one of those sit down and read Market Wizards books, but it's one of those books where it's like Joe Friday, just the facts, and in a really no-nonsense way, here's what you need to think about with a certain mathematical underpinning. And I think that's a really valuable service in this day and age. What caused you, building on your first work, what caused you to go down this path?
You're right. Go back to the mathematical underpinning. In this process of trying to decide, essentially, what am I going to invest in, which is a problem that I face myself all the time, and particularly when I stopped working in the hedge fund industry full-time and had more time to think about this. There's this kind of vast array of mathematical tools that are available for use. I actually found it really hard myself to kind of say, well, what are the important ones that I need to pick out and use in practice? Because a lot of them are either inappropriate or there's too much of them, or they're actually based on assumptions that are false and dangerous to use. And then in the process of kind of distilling that out to a series of relatively straightforward guidelines that I could use myself, I thought, well, I think there's another book here.
It was literally kind of like self-interest. I want to have my life going in a certain direction. And you're like, hold on, this could be useful for everybody else.
Yes, exactly. It may not be the reason why everyone likes to write books, but for me, it makes a lot of sense that if I've done all this work for myself, then I feel it's only right I could share it with other people.
One of the things that I like right in the beginning, you have a couple quotes, and I'm one for quotes, and I love this one because it's very Buffettism. It's Warren Buffett, and he says, quote, "Fund consultants like to require style boxes such as long, short, macro, international equities. At Berkshire, our only style box is smart. And when I read that, I'm thinking, well, okay, that is a really nice, pithy piece of wisdom. Makes a lot of sense. Put aside all the names for a second and all the jargon. Just being smart is the way to go. But then the second thought I start to have is, how in the world do we define the word smart, Mr. Buffett? Right? That's the whole trick here, is what is smart?
I think Buffett might say that smart is whatever he happens to be doing. But one of the real lessons of this book is that not everyone can be Warren Buffett. And actually, in trying to replicate what he does, you may end up doing much worse than if you just did some relatively simple and straightforward things yourself. If I look at the list of books on my shelf, I've got a lot of investment books on my shelf, and at one end I've got a book that's almost entirely full of mathematical equations. And I guess you could just say that book is an intelligent book. It's a book you have to have a lot of academic background to read, and the content is good, it's fine, but in many cases not of much practical use to the average guy on the street. And at the other end, you've got books that are like the Market Wizards books that are relatively easy to read, quite entertaining. You need a little bit more substance, a little bit more detail to actually to go down and start doing something sensible. For me, smart is in the middle, and I guess I think of it as kind of street smart. You're a guy that's intelligent, and you kind of know what you're doing, but you're not trying to overdo it with the academic theory. You're doing stuff that you know works. You don't make things more complicated than they need to be. You keep them as simple as they can be without making them too simple and too simplistic.
Big picture, just kind of a big picture point before I get into some of the meat, some of the detail. And again, this is one of those books where I really think it makes sense for people to have on the shelf. That's not a sales pitch for you, but it's one of those books. I've seen a lot of books, something that's easy to read, straightforward, practical, and allows the individual, the end user, to think about, in this day and age, across the globe, what's the thought process? What are some of the techniques you can use to assemble that portfolio for you? As I say all that, though, if I kind of diffuse away from that for a second and think big picture, so many people, and you kind of just hinted at this, will get caught up with the idea of, wow, look at Warren Buffett. His career, fantastic. The thing is, though, unless one has their money with Buffett, you're probably not going to replicate Buffett exactly. And not only, to take it even a step further, even if one has the smart portfolio, it doesn't mean your neighbor's going to have it. And it also could mean your neighbor has a smarter portfolio than you. And I think one of the tricks here is, how does one put the ego in check to not spend their life, literally every waking moment, trying to compare to either the neighbor benchmark or to the investment benchmark, that literally to be comfortable in your own skin, making good decisions, and then that's all you got. But if you go through life constantly comparing to everyone else, that's a little bit psycho, in my humble opinion. So
coming from the hedge fund industry, we spent our lives comparing ourselves to other people and to benchmarks. You're right, it's become a bit of an obsession. And my book, I give this phenomenon a name. I call it embarrassment. Because ultimately, it doesn't matter if you're performing versus the benchmark and you're outperforming the benchmark. If you're doing better than the benchmark, that's fine, that's no problem. But when you're underperforming the benchmark, and you've got to kind of say, well, yeah, we're underperforming the benchmark, and that's kind of embarrassing. And I think it's really important that people have a degree of self-knowledge and say, how much embarrassment can you cope with? Because frankly, if you're the kind of guy who, any slight underperformance or deviation from what the market is doing will make you feel bad and make you inclined to start messing around with your portfolio, then maybe you should just hold a market portfolio. Maybe you should just invest in a big global market cap ETF and just stop worrying about your investments. But at the other extreme, if you're someone like yourself, Mike, who is perfectly happy to be embarrassed and doesn't mind underperforming, you're like, well, I know I'm doing the right thing, and I don't frankly give a damn what anybody else thinks. Then that's fantastic, and you can obviously deviate your portfolio much more further away from that. But it is about self-knowledge, and not everyone has the same attitude that you have. And I think it's better that people recognize what their tolerance is for embarrassment, just as much as you need to calibrate your tolerance for risk when constructing a portfolio. I think that's just as important.
Would you put the word, as you use the word embarrassment, I can see that as one kind of emotion or one psychological state that an individual can be put into by looking at their neighbor's success. But is there also an element of, coveting, a certain jealousy involved there too? Is it, or do you see it just, it seems like there's a lot of different things going on there when an individual is always thinking about what the other person is doing. That's a lot of psychological energy to burn. Literally, physiologically, to think about the other person, their success, and what they're doing nonstop inside one's brain, physiologically, is burning energy. It requires a lot of calories to maintain that psychological framework.
I agree, and it's certainly, I think, kind of wired into our human nature that we like to compare ourselves to other people. And I think it requires a real conscious effort not to do that, and to force yourself to just focus on your own life and your own goals. And, I'd be lying to you if I said I never compared myself to other people.
Same here, of course.
I'm sitting here and looking at my neighbor's house, and it's bigger than my house. I see that every time I walk out the door, but the secret is for not to let it affect me and for me to think about all the things in my life that I'm happy with and comfortable with.
On your work here, you set forward, and I like this, 3 kind of big questions that we all have to think about. And sometimes when I can get into the nitty-gritty with someone on this show about their particular niche, it's nice to kind of just see these 3 questions you posit. What should you invest in? Number 1, what should you invest in? Number 2, how much money of your limited capital goes into each of those investments? Number 3, do you make changes along the way? Meaning, do you buy and sell along the way? Do you rebalance along the way? That's a really simple framework to look at life and look at markets and look at how one deploys their capital. Now, as we're going to get into, some of the details get a little more complicated. But if you start with that foundation, that's a pretty good place to start, isn't it?
It's always difficult to write the introduction to a book. And actually, this may surprise people who haven't written books. Mike, of course, yourself, you've written many books, so you probably know this. But so often the introduction is the last thing you write because you don't always have a clear idea of what you're going to write about when you start the book. With my first book, Systematic Trading, that was definitely the case. But with this book, I knew exactly what I wanted to talk about right from the start because, whenever people come up to me and ask me for investment advice, which unfortunately is quite a lot because people seem to think that I know what I'm talking about, which I don't necessarily think is true, but, people ask and you want to be polite, but pretty much any question they ask could be divided into one of those 3 categories. Should I buy Bitcoin? What should I buy? Should I buy Bitcoin? How much of my money should I put into stocks? And then, things look pretty bad in South Korea at the moment. Should I sell? Should I make changes to my portfolio? Should I sell my South Korean stocks? I thought, well, if I can write a book that tries to answer those 3 questions, then that should be pretty much able to answer all those questions that people have.
Let me keep you at that moment for a second, the social interaction, because I can tell through this work, and you kind of go there a little bit, the idea of people asking questions. I think you're going to agree with me. They are always asking questions for a finite time right now. Tell me what to do right now. And they don't seem to have any curiosity about what to do later. So what they're never doing is they're never asking, hey, Rob, what's the process exactly ongoing over time? It's, hey, man, can you give me a quick one that will kind of make me get an instant gratification because my account balance went up 1% the next day? It's kind of, I start to wonder how people, they get so focused on that damn outcome that they don't ask a smart guy, you, been around the block, they get to pull your ear, they bump into you in some random situation. And instead of saying, hey, man, I want your process. And if they ask you for your process, let's face it, you're going to get 10 times more interested in that person and giving them all you know versus whether they ask you for an outcome.
Again, you're right. But this absolutely does come down to our human instinct. If I think about an activity at which I'm definitely not an expert, like, for example, car maintenance. Okay. So my brother-in-law used to be a mechanic, and he knows kind of what he knows what he's doing. But I'm going to go up to him at a party and say, "Hey, Simon, got a problem with my car, and I'll describe the symptom. And I would expect him to say, oh, you should do X or Y, or actually, that sounds like a real bad problem. You need to take it to the garage and get it fixed. I wouldn't expect him to start saying, oh, well, actually, I think the problem is that you need, every week you need to be putting more oil in the car, and you need to be doing this, you need to be doing that. And there's actually a whole kind of regime of car maintenance that you should be getting involved with to avoid this problem having to come up to begin with. I think instinctively I'd probably be quite annoyed if he started giving me this lecture. I just want a quick answer. I think that's a natural human instinct. And with a car, it's okay. I mean,
I've been saying that's a natural human instinct. I mean, okay, but I mean, it could be Lord of the Flies on a desert island could be a natural human instinct too. Doesn't necessarily mean it's right.
Exactly. And I think the key point here is that the amount of damage that you can do to your financial wealth by not looking after your portfolio in a sensible way many times exceeds the damage you could do by not looking after your car, unless you're in a bizarre situation where you have a very, very expensive car and very little money to invest alongside it. For most people, time and effort thinking about their portfolio will be rewarded many times over because of the benefits of compound interest over time. But most people probably spend much less time thinking about their portfolios than they do about thinking about getting their cars fixed, which is why there's even more pressure to just have this quick fix answer.
Why do I need to think when the U.S. equity markets are straight up for, we're close to 10 years now? Why do I need to think?
Exactly. We're both old enough to remember what was happening in the late 90s when you just needed to buy any old stock with .com at the end of it, and you'd make loads of money. And in fact, if you listen to any academic expert who said, oh, you really ought to have a diversified portfolio with a spread of asset classes, relatively speaking, that would have looked like a pretty poor decision for those few crazy years when, the tech stocks just went through the moon.
In this conversation today, I want the audience to understand something, because we've only got around an hour, but I want the audience to understand your book that I've got in my hands, which is a really nice looking book, by the way. It's 527 pages. So we are going to simply touch on things today. So folks out there are going to, if you really want to dive in deep, you're going to have to go ahead and make the purchase. As a kind of a fair warning, because there's some density here. You did not write this in 1 week, to say the least. Listen, let's go to some topics that I think would be useful for the audience to think about overall. And I know you're pretty structured in this work, and you've got a pretty linear structure moving forward. An overriding topic, and we all discuss this most of our adult lives once we get into the investment thinking process, is diversification. But maybe we can take a few moments to open up, since the audience listening here is wide in terms of where they are from, what countries they're from. It is quite interesting, and I see this quite a bit with questions that come into my world from individuals that could be Australia, US, that could be Singapore, China, and this home bias. It's not great in 2017 to only be thinking inside your borders. But I don't know what the numbers would be. I don't know how that would break down. But I have a sneaky suspicion that the home bias is very strong, and probably well more than a majority of individuals really think only about their home country. And that just doesn't make a lot of sense in 2017.
No, it doesn't make sense. I mean, it doesn't make sense from a theoretical point of view, but it also doesn't make sense because, increasingly the world we live in today is one where capital does not respect national borders, and the companies are operating across borders, and consumers are buying things across borders. To just be focused purely on investments in your own country doesn't really make a lot of sense. But the reasons for it are fairly obvious. If I pick up the newspaper, I'm going to read all about all kinds of companies, and because newspapers tend to be fairly parochial in their coverage, they'll mostly be companies that are based in the UK, perhaps a few kind of glamorous US tech stocks thrown in for good measure. So when it comes to thinking about an investment portfolio, the average person will think, well, I want to buy a company that I understand and that I think I know something about. The first of those statements is probably okay. It makes a lot of sense to stick to investments that you understand. For example, I can't see myself ever investing in Bitcoin because I just, no matter how many times I read about it, I just don't understand why you would want to own it. But to buy something because you think you have some information that will allow you to prove your return and to beat the market, that's where the fallacy comes in, I think. The idea that by having a more concentrated portfolio of stocks that you think you understand and you think you can forecast the performance of will allow you to outperform the benchmark. I mean, yeah, sure, a few people will do it. If they're people you know, you'll think, wow, well, that guy managed to do it. I mean, Warren Buffett managed to do it by most of his career having a relatively concentrated portfolio. So that's clearly the way to make a lot of money. The problem is that people aren't used to thinking about life in a probabilistic sense and thinking about alternative scenarios. And sure, if you have a highly concentrated portfolio, then your upside is much higher than if you have a diversified portfolio. But your downside is also much higher. And your expected average performance, which is what people really ought to be thinking about, is going to be less. If you can't predict the future, generally speaking, you can't. It's much harder than you think. Then diversification is the best way of dealing with all of the uncertainties that lie ahead.
As I think about that, I think about the lifespan of the typical human. And I think about when does one start to have assets to invest? Typically, unless there was some good luck or a little good fortune, typically it's going to start in your 30s. But here's the tricky thing, and I think this is where diversification plays such a critical role that people don't think about, is if you think about that lifespan of when you're really going to be dealing with money, let's say between the ages of 30 and 50, there's no way that anybody can know during that window, when will the boom happen and when will the downturn happen, and how many of those will happen during your particular lot in life. It's so unpredictable, and so there's so much uncertainty. And, you could have an individual, you could have a particular generation where they get their home run boom in their 20s. Another generation could get their home run boom in their 40s. Maybe one of those booms is fake and blows up like the dot-com bubble. Maybe one of them goes on forever, like the one we're in right now. So it's a really, when you talk about probabilistic, it's really like, how can one sit down and carve up their life and think about all the if-then contingencies that could possibly happen and realize we can't know a damn thing, and boom, you're right back to diversification and right back to a smart portfolio.
Exactly. I mean, if I just look at the last 20 years, it takes us back to 1997. In 97, we had the Asian crisis. In 98, we had the Russian crisis. Then we had the dot-com boom, and then in 2000, it burst. And then things went pretty quiet for a few years. Then in 2007, things got crazy again. And then even in the last 18 months, there's been the Brexit vote in the UK. There's been the accession of a certain Mr. Trump to the presidency in the US. I mean, I don't know what's going to happen in 6 months' time. I mean, in 6 months' time, we could be in the middle of a nuclear war. The stock market could have collapsed, or it could have carried on going. People just need to know a little bit of history and just think back and honestly say to themselves, well, if I was sitting in 1997 without any of the information available to me that's available to me now, in other words, with no hindsight bias, could I really have predicted all these things could have happened?
Oh, man, nobody.
Exactly. I mean, even Warren Buffett would have. Actually, Warren Buffett doesn't try and predict the future. I think this might be.
He's such an outlier, though, in many ways.
Exactly.
I don't know how useful he is for. We all love to talk about him, and he's got some great lines, and he's extremely successful. But when you get that much of a head start on everybody else, and when the world goes to hell in a handbasket in 2008, and you're Warren Buffett, and you can basically start buying banks because you have all the cash, I don't know how much any of us can really use that narrative, right?
As I said before, I don't think we should look at his mostly concentrated portfolio and say we can copy that. But I think we can look at a couple of things that he does have an attitude towards, which is I don't think he does try and predict the future. He tries to buy companies that he thinks are a good value, and then his expectation is that over time he'll get a good return from those. But he's not going to say, well, in over the next 10 years I expect to make this much percentage from that company. In many respects, he's got a much more well calibrated idea of his limited ability to forecast than a lot of human beings have.
Rob, I got a question from somebody recently. That particular trading style, and they were down, I don't know how aggressive they were, but they were down 40%. And he seemed very panicked. And I said, well, okay, let's talk about this down 40%. Have you investigated, have you looked at the elders, so to speak, that have come before you and looked at what they have done? I can think of this great line from Buffett where he essentially says, look, if you're in the markets and you can't afford to lose 50%, if you can't handle that, maybe you should not be in the markets. Now, as I take that thought from the individual that emailed me, I realized he had not read the Warren Buffett line. He had not looked at other track records of other, quote, market wizards. So he was very naive in that sense. But then I think about, okay, so many people, when they start to put together the smart portfolio, they say, okay, I want to target my return. I want to control my volatility. And people think they can do that perfectly. And there's never perfection there. We're back to your line about probabilities. There's not perfection, but so many people want perfection. And again, back to that Buffett line, how many people out there of the investing public right now know that Warren Buffett has said that? And even if they knew he said it, would they buy into it? Would they think it's important? Would they think it's relevant? It's really, it's a minefield here, isn't it?
Absolutely. I think it's really important that, you mentioned there targeting risk and controlling volatility. I think one of those things is at least almost possible, and the other is much more difficult. I think targeting a certain return is extremely difficult because you just do not know what's going to happen in the future. Now, controlling your volatility, I think you can construct your portfolio in such a way that you have a reasonable idea of what your volatility is likely to be. The important thing is to be able to say, well, actually, I put together my portfolio, I've got a certain percentage of stocks, a certain percentage of bonds. Now, if I do look at history, and if I look at not like the worst case scenario, but a pretty bad scenario, I know there's a chance that over the next 20 years I could actually lose perhaps 50%. And to be able to say, I'm comfortable with that because I think I need that kind of aggressive portfolio to hopefully compound my money in the future. The important thing is to have a good understanding of what your likely volatility is going to be, of what your likely downside is going to be. And you're right, most people have extremely unrealistic expectations and think that, even looking at someone like Buffett or any kind of really good trader, you're looking at the outliers, you're looking at the guys on the edge of the distribution. What you have to say is, well, actually, it might be that I'm that good. It's unlikely, but it might be. It's more likely that I'm going to be average. But in fact, if anything, I'm going to be a little conservative and assume that things don't go well. If things don't go well with this portfolio, yes, I may end up with a 50% drawdown. That's too much. I can't cope with that. Fine. I need to dial back my volatility with the understanding I'm probably going to be dialing back the expected return I'll make in the future. I think most people, they may start buying hot stocks or running some leverage trading strategy, and very quickly they run into a large loss. It will happen. It's just the laws of statistics. You may get lucky to begin with, or you may lose money to begin with, but at some point you'll get a large loss. And because they aren't psychologically ready for it, the first instinct is to pull the panic lever and turn the whole thing off, sell everything. And of course, that's usually the worst thing to do, because these kinds of strategies and ideas and concepts only work if you stick to them over time.
I know it's not an exact representation, but when we talk about return, we talk about volatility. Many people think about volatility as risk. So many folks really want to think of, let me get the tiniest volatility, and then I will then magically have all of this fantastic return. I've seen this for a long, long time, that folks will get so preoccupied with reducing volatility, like it can be done perfectly. I know it can be done, as you make the case, better than targeting a return. But if your volatility is so low in your portfolio, I don't know where the return is supposed to come from.
In quant finance, some people call this the waterbed effect. Imagine you've got a portfolio, and imagine that's a waterbed. If you sit at one edge of the waterbed, you're kind of pushing down the risk that you're aware of, because it's right underneath you. But that risk is moving away somewhere else where you can't necessarily see it. And a really good example of this was the kind of stuff that was going on in the lead up to 2007 and 2008. Those guys were constructing portfolios, using much more sophisticated methods than we're going to talk about today, or I talk about in my book. But they were constructing portfolios where the volatility was really minimized. I mean, it was down to close to zero. They were very comfortable with those portfolios. But all that happened was the risk had been pushed away into another place. And they actually had a massive bet on something else going on that they assumed, of course, would never happen. And then when it did happen, these portfolios went from having very little risk to having huge amounts of risk. Personally, I like to see my volatility and be aware of it. And I know I'd rather have a portfolio where the volatility is reasonably large, but I kind of like, well, all the bad stuff's happening in front of me. There's no weird stuff lurking in the corner of the waterbed to come and bite me later. You can't remove volatility entirely without also removing risk. And if you think you can, then you're either an idiot or perhaps at the other extreme, that you know so much mathematics that you think you can do it in theory, when in practice it's not going to happen.
I convinced my parents when I was a teenager for a couple of years in high school to have a waterbed. And it was some small bed. It was very cheap. It must have burst at some point in time. Literally, I think some kind of mold was growing in there. I like the waterbed risk.
Yeah, I mean, well, a great metaphor for the entire financial crisis. I mean, we could spend an hour developing this idea of the waterbed where a puncture happens and mold grows in the corner and it smells bad.
And sometimes you can't really, you're on top and you don't even detect the smell because you have a top layer of plastic, you have a bottom layer of plastic, you've got water in between. So unless you kind of like can pull the water up and get underneath the plastic, you might not necessarily know something's even growing there.
Yeah, that's like the different tranches in the CDOs that these guys were signing in 2007. Yeah.
Let you take the audience somewhere a little more specific, which I think would be a good educational insight and bring them into your work a little bit more. And the idea of returns, the different types of returns. And you kind of go down the path of making sure people understand a difference between, let's say, geometric mean return and arithmetic return. Walk my audience through that so they kind of get your process there. And there's a lot of different things that are going to come into play as you explain this. For example, compounding, consistency versus lumpy returns. Why don't I let you bring people into your world?
It's probably easiest to explain this by just looking at a really simple example. Well, let's see if you can get this question right.
You're not putting me on the spot. Come on.
You've got an investment over 3 years. In the first year, you get 30%, which is great. In the second year, you get 30%, which is also great. And in the third year, you lose 30%. Let's say you started with $100. So roughly how much money do you think you'd have after 3 years? So you made 30%, 30%, and then you've lost 30%.
You're going to be worse off. All those first two 30s didn't help you.
Exactly. So you will have still made some money, but not as much as you might expect. Most people, when you ask them that question, they'll say, well, they're probably going to have another $30, right? Because I've made $30 in the first year. I've made a bit more than $30 in the second year because of compounding, and then I lose $30 in the third year. It's probably got about $130. But actually, you've got a little bit less than $119. You've made 18%. And if you actually sort of average that out over the 3 years, that's the same as if you'd made about 5.8% every year. The arithmetic average of 30, 30, and minus 30 is really easy to work out because the last two numbers cancel. So you've got 30% over 3 years, which averages out to 10% a year. But the geometric average, which is just the amount of money you'd have made if you'd had constant growth in each year, comes out at 5.8%. That's pretty much almost half the arithmetic return. So there's a huge difference there. The important point here is that arithmetic returns really don't matter to most people. An extreme case might be that you gave all your money to Bernie Madoff and you were making 8% a year for 30 years. And then in the last year, you lose 100% because it turns out that the whole thing was a giant Ponzi scheme. Now, if you work out the arithmetic average of 8% over 30 years and then minus 100% at the end, it'll come out to about 6 or 7%. But you haven't made 6 or 7%. You've made nothing. You've lost everything you've got. Your geometric return is actually massively negative. It's really dangerous, really, to think about arithmetic returns rather than geometric returns, because geometric returns really accurately reflect what you're going to be left with at the end of your investment period. And now the important point here is that the more volatile an investment is, the more you've got the big swings, the bigger the difference there'll be between an arithmetic return and a geometric return. The simple example I gave, 30, 30, minus 30, that's quite a lot of volatility. The geometric return is quite a lot less than the arithmetic return. For stocks, which are relatively risky investments, there's going to be a relatively large gap between arithmetic and geometric returns. For bonds, which are usually safer, there's going to be a smaller gap. So what all this means is that the types of portfolios that people kind of assume you should hold, which is that, if you've got a huge amount of appetite for risk and you're happy to see a lot of volatility in your portfolio, the idea is you should have all of your money in stocks. But if you do the maths and kind of work it out, of course, I've done it for you in the book, so you don't need to replicate the result. But you actually find that adding a little bit of bonds to an all-stock portfolio actually actually keeps the geometric return constant or even improves it slightly. So once you start thinking in geometric return space, you will tend to be pushed towards holding a more diversified portfolio than if you're thinking purely about arithmetic returns.
I think the audience can start to think about what, as you just described that, what it opens up to. So for example, use the word period. Okay, you gave a 3-year period example. 3 years is not going to be the period that people are thinking about generally. Thinking about that period honestly is going to be very important. You just said swing. I mean, what's the definition of swing? It's going to be different depending on what that portfolio looks like and depending on perhaps what you're comfortable with. And then as you just mentioned there too, as you go down the diversification path, not only like earlier in our conversation, we were talking about the home country bias. You have the typical long-only investments you can make, but then you also start to think about diversification in terms of strategy. It quickly opens up to Pandora's box of all the issues you have to think about. The question I come back to you is, people can imagine, okay, wow, we can get into the details really fast. How much is too much? How does one know from your perspective that we have reached the diversification threshold? We don't need any more. We are good.
That depends on your appetite for risk, of course. Let's say you start with a portfolio that's just entirely in stocks. Now, if you need to put, roughly 10 or maybe 20% of that portfolio into a safer asset like bonds, if you do that, your geometric return will pretty much remain unchanged, maybe even increase slightly. So that's kind of I would say the absolute minimum amount of diversification. If you believe in the story of geometric return, then no one should be running around with 100% invested in stocks. They should have 20% of their portfolio in assets with a lower volatility, which could be bonds, or you could also talk about alternative assets or strategies.
But beyond the math of that, which you go into, there's also just a practical thinking here. This is like almost old school biblical passages. Save some for a rainy day. I mean, you don't know what's going to happen. Keep some powder dry. It's like the old standards.
Exactly. I mean, the nice thing about just putting a little bit of safer assets into a risky portfolio is it has a real fast effect on reducing things like your drawdown, the maximum amount of money you'd expect to be down during a 30-year investment period. Makes the very worst months look just a little bit better quite quickly. Adding a little bit of safe assets to your recipe of risky stocks in your portfolio quite quickly has quite a dramatic effect. You don't need a lot, 10%, 20%. Beyond that, then you will actually start affecting your returns. And that will make sense if you're someone who isn't comfortable with the kind of large swings or drawdowns of a portfolio that's 80% stocks, 20% bonds. You'll reach a point of diversification where you're giving up more return than you're happy for less risk that you don't really need. It's about judging that. But I would say for most people, the right asset allocation should be somewhere between 20% in bonds and 60% in bonds. But that's still a pretty wide window, but it kind of does help narrow down the problem set to a smaller area.
Let me pick on that word for a second you just used, the word most. I was just scribbling some notes down here, and I was thinking to myself, okay, as I go through your work here, if I go through Smart Portfolios, I can think about what would be the best path for the average investor. What would be the best path for the investor that wants to be above average, perhaps wants to be rich? And what would be the best path for the investor trader that wants to get super rich? To think about that along those lines is people generally think that it's just a pure choice of those three, for example, just kind of making an example here. But if you want to choose the super rich direction, you might take a guy like yourself. You could say, hey, you really want to go down that path? Well, here you go. Here's how you crank up the risk. You got to be willing to tolerate this drawdown. It doesn't mean you're going to get there, though, because there's so much luck in play, there's so much uncertainty in play, that if you go for that super rich path, there's no guarantee.
Absolutely. I mean, I think a good analogy here is buying lottery tickets. So, most people are unlikely to be worth $100 million starting from zero, or pretty much zero, in one day, unless they buy a lottery ticket. There are no other investments, and I use the word investment here loosely, but there are no other investments that give you that kind of payoff profile. If you want to even have the tiniest chance of being a Dessa or a centimillionaire tomorrow, then yeah, you should buy a lottery ticket. But that doesn't mean that buying a lottery ticket is a good investment, because actually, your expectation, the average path, in fact, the vast majority of future possibilities is that you'll end up losing the $2 or whatever the lottery ticket cost you. And then there's a small fraction of paths where you'll make a relatively modest amount of money. Now, it's the same with making risky investments, except that the numbers aren't quite as dramatic. But yeah, if you invest in an extremely concentrated portfolio, so maybe just buying one or two really risky tech stocks, then yes, there's an outside chance that in 30 years' time that portfolio will be worth $100 million. I mean, yeah, you could go from a $10,000 portfolio to a multi-million-dollar portfolio, tens of millions in 30 years, if you happen to pick just the right stock. But the point is that doing that is extremely difficult. And in most possibilities of the future, just like in most possibilities of the future where that lottery ticket isn't worth anything, you'll end up with a very poor return and probably even losing your entire investment, because risky companies have a nasty habit of going bust. If someone wants to get rich, then yeah, there is a more sensible way of doing it, which is to invest in a portfolio that has the maximum amount of diversification possible, which means you're looking at putting perhaps 2/3 of your money in bonds and 1/3 in stocks. And the reason for that particular ratio is that the bonds in your portfolio will be contributing less to the risk of the portfolio overall. The stocks will be contributing more. If you work out the numbers, then actually you end up with a risk contribution of about 50-50. So that's the most diversified portfolio you can have. And then what you do is you then leverage that portfolio. You buy it using a margin in a brokerage account, or you use futures, or you use leveraged ETFs, although of those three options, I would argue against the latter. I think it's not such a good move. And if you do that, then you will have a reasonable chance of becoming very wealthy. But of course, the downside will be much bigger than if you hadn't leveraged the portfolio. But that's still a more sensible way of doing that kind of investment with that kind of risk than just buying one or two tech stocks and kind of crossing your fingers and hoping.
I look at your cover right now and I see practical guide is kind of offset in a different color. And your practical guide from your perspective, which I agree is practical, is up against, for example, Hollywood, The Big Short, Michael Burry. Michael Burry, a brilliant man who, on the spectrum to some degree, Asperger's brilliance, decides almost like in his brain, like a puzzle. He was not acting like a typical investor. He saw this unique opportunity. Perhaps he might not have even got the ability to short what he wanted to short, if not, but for some luck involved there. He could have even had the right strategy and not been able to execute it. But what's really interesting is Hollywood goes down that path. You see the success of one person on one bet, one super bet. It's fun to look at, but for me, I've always looked at traders and investors that have done something over time where they've made buys and sells over time, many decades over time. And that's much more interesting to me than the one-offs. This isn't a criticism, it's not hate, but you look at the VC community right now. There are plenty of venture capital investors that plunk down some money and they hit it big on Snapchat. Does that mean that was a strategy? Or there's a lot of luck involved in some of these one-off events. But what's so crazy is the one-off events become the things of headlines, the things of books, the things of legend. And often there's just a huge stroke of luck there. I'm not trying to criticize or take anything away from someone's success, but if we're going to be honest about it from a mathematical standpoint, the direction that you've gone in your work is much more reasonable and much more truthful.
Although, unfortunately, no one's ever going to make a film about me.
Smart portfolios will not be the next big Hollywood thing coming out.
It seems unlikely. And you know what? I'm not sure that anyone will necessarily make a film about Warren Buffett either. but we keep returning to him as a good example or a bad example. But in terms of being a good example, he is someone who has had a process that he's repeated, many times over a very long period of time. And he's made not one decision that turned out just by luck to be great, but hundreds or even thousands of decisions, of which the vast majority turned out to be good decisions. But you're absolutely right. I mean, I think the key thing to say here is that if you think about the VC community, actually, the way that VC works is they probably had in their portfolio perhaps 50 or even 100 investments, of which, one turned out to be Snapchat, and a couple maybe broke even, and all the rest just disappeared. And that's just the economics of that business. You have to actually make a diversified set of investments.
For the main players on Sand Hill Road in Palo Alto, that's what they're doing. But there are plenty of people in the modern age right now that are plunking down some bucks and getting lucky on their first hit, and then they're world famous.
Exactly. I mean, it comes down to the old adage, are you better off being a gambler in a casino, or are you better off running a casino? If you go into a casino and you put all your money down on red and it comes up red, I mean, people might make films about you, but I hope no sensible person would think, Mike did this, Mike Covel did this.
I want to be Steve Wynn or Sheldon Adelson in my second life. Not only are they the house, so to speak, but it looks like it's probably a lot of fun to own one of those large casinos in Vegas or Macau.
Absolutely. But that's the point, right? Being the house, you're essentially making thousands and thousands of bets. Every time someone comes into a casino and puts money down, you're essentially making a bet with them. But you're making that bet knowing that the odds are tilted very slightly in your favor. You know that over time you've got this essentially vast, diversified set of investments, all of these guys coming in. And every now and then, you get a big gambler come in, a whale, as they call them in the industry, who puts a lot of money down on the table. And that sort of picks up your volatility, and you may end up down on that day or that week. But over time, your expectation is that you'll be profitable. That's really what good investors should be thinking about. They should be thinking about having a diversified set of opportunities on which they have an expectation they will, make a small profit, which will limit their upside, yes, but it will also limit their downside. And then it's a question of how much downside you think you can cope with, and you can swap that for upside by making your portfolio a little bit riskier, as long as you don't go too far.
The book, Smart Portfolios, a practical guide to building and maintaining intelligent investment portfolios. Your other book, Systematic Trading. Good reads, both. And for sure, I think people would really like this newest work as a reference on the shelf. I recommend, but no one better come back to me and say, hey, this was not, Market Wizards, because it's not. It's not Market Wizards. That's not the point. It's something that you can really open up to any page and get the juices flowing in terms of what's a good thought process, not here's a guy making a prediction about what's going to happen next month or next year. It's about the process. And there are some really practical ways, mathematical ways to put a good process in motion for your life. And if you're too old and you're too arrogant and you're too ignorant and you don't want to do it, buy it for your kids.
Absolutely. It'll be a great Christmas present. I think any 9 or 10-year-old will be very pleased with a 527-page book on portfolio optimization.
No, they're not. Or maybe it's like the 70-year-old investor buying for his 40-year-old son or something like that, I think the kid's going to be like, did you really buy this for me? You bought this for me for Christmas? Is this what you got me? Who's this guy Carver? I don't want this book. Give me some money. Hey, Rob, the book is everywhere. Is there a website we can send people to?
The best place is probably on my website, which is systematicmoney.org. And on there you can get links to the best places to buy both the books, and also information if you still haven't decided whether you want to purchase, gives you some more information about them, and also has links to spreadsheets that you can use to implement many of the concepts of the book.
Robert, I appreciate you taking the time today. Hopefully we'll talk again in the future when number 3 comes out, because you probably won't be able to sit still. I'm sure you'll come up with another one.
Okay, Mike. Really nice talking to you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.